Business Pulse Talk Radio. I'm your host, Michael Brette. Business Pulse Radio is the heartbeat of business. We're about business all the time. Today we're going to be talking about taking your company public. Now, I know most of you have probably read the Wall Street Journal and listened to Fox News and heard about companies, whether it's in technology or cannabis, whatever industry, doing an IPO, going public, getting listed. So we're going to be talking about the process of taking your company public and if it's appropriate to go public. And I'll get into that in a minute, because going public is time consuming and it's expensive. As I've always said, there's no such thing as a free lunch, and certainly going public is not a free lunch. We're going to be talking about reverse mergers or a Reg A+. Those are a couple of methods of taking your company public. We're going to go into the ins and outs of which one is better, which one you should consider. We'll do the pros and cons of each one. And then we're going to talk about the reason for going public. Now, there's only one reason to go public, and that's to raise capital. Now, you'll hear from a lot of other brokers and consultants and maybe attorneys or accountants or whatever that you can get rich. You become a multimillionaire if you take your company public. You need to discount that for what it's worth. I've realized that a lot of people look at Mark Zuckerberg from Facebook and all the other people that have taken their companies public and what their stock is worth. But that's a whole different ballgame than with most companies. And again, we're going to be addressing those issues. But keep in mind, if you're considering taking your company public, the only reason you want to go through the time and expense of going public is to raise capital. And so you have to have a proper valuation for your company. Your company has to have certain requirements to entice institutional type capital sources to your venture. Now, let's talk about the methods of going public. Certainly there's the IPO. That's a traditional IPO where you contract with Wall Street investment banks to do an underwriting, whether it's a firm underwriting or a best efforts. Firm underwriting means they guarantee they're going to raise X number of dollars. They don't. They pull the money out of their pocket. Best efforts is, we're going to raise $1 billion maybe. So it's a best efforts. Now that's a traditional IPO. Now a traditional IPO is very time consuming. It can take anywhere from 12 to 24 months to get all the legal paperwork together, get your accounting, get your audited financials. And then you have to do road shows. The broker dealers, the investment banks take you on road shows to introduce you to institutional investors. You make a presentation. You try to convince them why they should, buy your shares out of the offering or support it in the open market. As an alternative to that, there's a vehicle called a reverse merger. Now, a reverse merger is when you have a private company, your company, and then you find a pre-existing publicly traded company that for one reason or another is, they really can't get any traction. Nobody is interested in their particular business model. Nobody wants to really buy the stock. For whatever reason, you can work out a deal with them that where you take your private company and you merge the public vehicle and the private company together, and the surviving company is the publicly traded company. Now, I'm simplifying a little bit just because we only have a 30-minute show. But that's, in a nutshell, what a reverse merger is. They can be very expensive. When you try to do a merger like that, typically the reverse merger candidate, the shell, the public vehicle, is going to want anywhere from $250,000 to $500,000 in cash for the trading vehicle, because they value that as a certain dollar amount for all the things that they've gone through to get a trading. So that's a negative in my mind. And I've done a number of reverse mergers over the years. Some have been very successful. Other ones have floundered. And I'll explain that in a minute, how they flounder. But you want to approach a reverse merger kind of with a jaundiced eye because of the expense involved in buying a vehicle like that, a shell. Because no matter how much due diligence you do, or you have your securities counsel do the due diligence on the shell, you never really know what the underlying liabilities are going to be. There could be disgruntled shareholders out there that are just waiting for a viable company to merge, and then they're going to pounce on the vehicle with lawsuits, and for whatever reason. Some may be valid, some may be not. So with a reverse merger, you need to be very careful about the vehicle that you're going to merge with. Now, some brokers out there that are selling shells will tell you, they can raise you, tens of millions of dollars, and, it's a quicker way of going than an IPO or a registration. That really is a half-truth. Nobody can raise money for you as a public vehicle unless you have certain requirements. In other words, you need to have a certain float in your stock. You need to have some revenues generating. You need to give the public, a reason to want to invest in your company, either to buy the stock in the open market or buy it directly from your company at a discount. So, again, when you're approaching going public, make sure you get good SEC counsel and don't just listen to somebody that has a shell that they're peddling. Now, that's a reverse merger. Now, in 2012, the Jobs Act was passed to make raising capital easier for companies. And as part of that, they passed what's called Regulation A+. Now, that's a vehicle that companies can use. It's a filing with the SEC that you can use to raise up to $50 million every 12 months. And you can take money from accredited investors as well as non-accredited investors. You're allowed to advertise your Reg A offering in seminars, radio, TV, and a lot of other methods that you couldn't before the Jobs Act was passed. Now, the plus side of a Regulation A is it is a vehicle to go public. However, you don't have to. You can go through the process of a Reg A to raise, 15 to 20 million, up to $50 million. But you don't have to get listed on an exchange like NASDAQ or the New York. But it is a good idea if you're going through the process, the legal expense, the accounting, and you need audited financials, it's always a good idea to have the end game to be listed. So the process would be you would have your SEC counsel file an S1, a Form A1 to with the SEC, to take your company through the Reg A process. Now, there's really no qualifying process with the SEC. It's usually takes maybe 60 to 90 days, and you become effective, which means you can start offering your securities, whether it's common stock or debt, other forms of equity preferred, to the public in general to invest in your company. So that's the Reg A Plus method of either going public or raising capital. Now, as far as raising capital, as I mentioned earlier at the top of the show, investors are really looking for the next Facebook, the next Google, as we all say in my business. They're looking for something that is going to give them an excellent return on their money. That's the reason they invest in public companies. So again, at the top of the hour, we talked about taking your company public. You need to really think long and hard about taking your company public and why you want to take it public. You need to do some serious thinking in your business sector, in your business in particular, is it attractive for somebody to want to buy your stock in the open market, call their stockbroker up and say, hey, I want to buy 100,000 shares of XYZ company. What's going to motivate them to want to do that? Well, it's going to be, what's your business model? What's the management? Is the management strong enough to execute on the business model? Do you have some revenues? I know there's a lot of stuff that's going on over the internet that anybody can go public whether you have revenue or not. In my professional opinion, and I've been doing this 25 years, I would not take a company public that's not generating at least $1 million to $2 million in revenue, because that really is one of the motivating factors for either individuals or institutional money to get behind a publicly traded company and want to invest. And certainly, if you're planning on getting off of the OTC market and going to a major exchange like NASDAQ or the New York Stock Exchange, there are a lot of different requirements that NASDAQ has for you to list. In other words, you have to have so many shareholders. You have to have so much in revenue. You have to have so many shares in the float. The requirements go on, and these are some of the giveaways I have on the show today. So if you email me after the show at mikebrette@gmail.com, that's Mike Brette, BRETTE, @gmail.com. I've got a lot of reports, a lot of white papers that I will send to you. One of them is on the Reg A Plus process of going public, how to raise capital through that process. Again, valuations, how to establish your valuation. All these elements are important for your company and for potential investors to come in. And also, I have the requirements for listing your company on NASDAQ. I have to laugh. I see on different websites and different press releases that companies put out, they're a 10-cent stock. That's considered a penny stock. Anything that's less than $5 is considered to be a penny stock. And institutional investors typically stay away from investing or supporting those type of companies. But I see these companies put out press releases, and they're a 10-cent stock, and they say, we made application to apply for NASDAQ. Now, come on. You do a little research into the company. They don't, first on the price, you have to be a $4 stock. And they're 10 cents, and they feel they're going to, in 6 months, they're going to be $4. How's that going to happen? You have to have over 2,000 shareholders, and most of them have maybe 100 to 200 shareholders. They can't meet the requirement. So I really don't know why they put out a press release that says they're making application to NASDAQ when you can tell by looking at their OTC market filings that they don't qualify now, and they're probably not going to qualify in 12 to 24 months. So again, going to a major listing, there's some requirements, but there's also the benefit of being on a listed exchange, and that is your access to capital. I always tell clients, look, go where the money is, and the money is with investment banks, FINRA broker-dealers, private equity, family offices, and the compliance department of these institutional firms, which have all the money to go in and support a public stock in the open market, to invest in your company. The compliance department of these firms, these institutional investors, will not allow them to get involved with a company that's less than $5. So if you're considering taking your company public, your options are somewhat limited on how you're going to access capital if you're less than $5. Okay, so what do? Either your management, your board of directors, and you have sat down and figured out you want to go public through a reverse merger or some other method. Where do you access capital? There are firms out there, not institutional firms, but there are firms out there that provide what's called an equity line of credit or convertible debt. You need to be very, very careful about accessing that type of capital with your public company, because typically associated with equity lines of credit and convertible debt, convertible notes, typically it's a toxic type of financing. Now, what do I mean by that? Most companies that go public through the reverse merger process or haven't established a price of $5 or more and who can't get on a major exchange, they're kind of relegated to dealing with these other individuals or firms that have toxic financing. So the typical scenario will be you'll get a phone call from somebody and say, hey, we've been following your company. We have money available. We're investors. We'll give you a $10 million line of credit that you can draw down on over 36 months. What do you say? And we'll start with $100,000 now, and then the scenario would be whenever you want additional capital, you agree to sell us X number of shares at a discounted price. Now, this is where it becomes toxic. What these toxic firms do is they take your price. Let's say your stock's trading for 10 cents today. They typically do what's called a look-back period, which they'll look back either 10 days or 30 days to find out the lowest price of what your stock traded for. So let's say your current price today is 10 cents. They do the look-back period, let's say 10 to 15 days, and they find out your stock is trading for 2 cents. That's the price they're going to offer to purchase your stock at a 50% discount. So now you're a 10-cent stock. They're agreeing to buy your stock at a penny, 50% of 2 cents. So you're so desperate for the money, you agree to the terms and conditions without really having an SEC qualified attorney look at their paperwork. So you sign it, you execute it, you send them X number of shares, and now you're in a scenario which we call a death spiral, which means now you've got a 10-cent stock, they're buying it for a penny, they're going to be selling it into the market for whatever price they can get above a penny, 2 cents, 3 cents, 4 cents, but they never sell it at your going market price. So what happens? Your stock price goes down, 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 down. There's dilution with your shareholders, and the only one who wins out on it or makes money is the toxic firm who gave you the equity line of credit and convertible debt. And the reason I mention all this, I know it might sound confusing at first, but again, I have white papers on the topic. I'm available for a telephone conversation or email consultations also if you're considering, taking your company public. I've been doing this 25 years. I know where, the good people are, the bad people. I know how to counsel you on what to do and what not to do. Unfortunately, a lot of people don't take my advice, or they take the advice of their own counselors and they end up getting hurt. But I'm telling you this not to scare you away from taking your company public. I think going public is an excellent strategy for your existing investors or shareholders. It's certainly a good vehicle for you as the founder at some point in time when you can liquidate some or all of your position to get some capital into your own pocket. So I think going public is viable for most businesses if they take the time to study the market and study the methods of going public. Now, one of the other ways that publicly traded companies can raise money, typically, your stock has got to be trading at that $5 level where you can bring institutions in. And there's a method called at-the-market financing, an ATM. So at-the-market financing. What that means is your stock is trading at $5. Institutions will come in and at a small discount, maybe a 5% discount off of that $5 price because of different fees involved, and it's called at-the-market financing. And you typically have a registration you've gone through, and they buy the stock directly from you, and they'll also support it. They won't be selling the stock into the marketplace to hurt the company. So that's called at-the-market financing, and it's typically available to companies that are on a major exchange, such as NASDAQ or the New York Stock Exchange. I've done a number of at-the-market financings for an oil and gas company. We raised almost $20 million, and we had a number of New York investment banking firms come in at the market. We've had some investment banking firms here on the West Coast come in at the market, and it was attractive to them because the liquidity that we built into the stock price. We were able to do a number of road shows and different meetings that got the stock very liquid and got the stock price up to that $5 price tag that they were looking for. So that's called an at-the-market offering. You're listening to Business Pulse Talk Radio. I'm your host, Michael Brette. Business Pulse Talk Radio is the heartbeat of business. We're all about business all the time. And just a way of a little bit of background, my company is called Small Cap Equity Advisors. We're a fee-based consulting firm, and we advise clients on a wide variety of transactional business matters, startup consulting, valuations for your business, reverse mergers, Reg A+, using PIPE financing to raise capital for your public company, equity crowdfunding, Reg A+, mergers and acquisitions. And we also have, over the 25 years, we built up a nice network of retail and institutional firms that will support your effort in taking your company public. And again, I mentioned I have white papers and I have other information. So if you email me at mikebrette@gmail.com, that's Mike Brette, B-R-E-T-T-E, @gmail.com, I can send you some information on valuations. I can send you information on doing a Reg A+ offering. I can send you information on doing a reverse merger. And we do have some shells that are available. I hate to use the word shell. It's got a bad connotation in the market, but, vehicles, I'll use that word. We do have a number of publicly traded vehicles that are available for merger with your company. So we have this information available. It's available by email, and I can consult with you via email. If you're located in California, we can always do a face-to-face meeting also. Again, today's topic is taking your company public. It's not for the faint of heart. Believe me, it's an expensive process to go through. If you decide to do a Reg A+ offering and you contact a securities lawyer, typically it's going to be around $65,000 for legal fees for a Reg A+. Then you've got accounting fees, which could be as much as $25,000 because you need 2 years of audited financial statements. Even if your company hasn't had much activity in regard to revenue, you still need to have audited financial statements of the past 2 years. Now, I emphasize that point because 2 years ago, 3 years ago, a number of companies went public with a Reg A+ at a certain dollar amount, $5, $6, $7 a share. You get listed on NASDAQ, and within about 30 days or 60 days, their stock price drops by over 50%. Number of reasons for that. First off, they went public too soon. They didn't have revenue. Secondly, the valuation for the company was set way too high. And then so when investors finally do enough checking into the company, once the filings are done, they figure out, the valuation is just out of sight. So they start either shorting the stock or nobody is supporting the stock and the stock price drops. So NASDAQ now and the New York Stock Exchange have stopped taking companies for listing through Reg A+ unless they've had at least 2 years of seasoning, been in business 2 years with revenue. So again, no matter who you work with, whether you work with my firm, Small Cap Equity Advisors, or you work with somebody else you choose, make sure the reason you're going public is solid, your fundamentals are solid, you have revenue of, like I said, we're $1 million to $2 million in revenue at a minimum, that you have some kind of proprietary IP, intellectual property, some reason to give people, again, a reason to buy. And you look at it from your standpoint. Look at say, what would I do with this company if it was presented to me on this basis with facts and figures? Would I take my money and buy the stock in the open market? And if your answer is no, then you shouldn't take. That's one of the reasons you should not take your company public. Now, in last week's episode, we had a client on called Aptech, A-P-P-T-E-C-H, Aptech Corp, based in Carlsbad, California, and they're a publicly traded company. The stock symbol is APCX. I'm a shareholder in that company. I've been consulting with them for about 6 years, and I ask you to take a look at it because you'll see the process of going public. You'll see the process of what's involved with a public company, what you need to do as far as press releases, and things of that nature. So that's Aptech Corp. And look at our old video that was up last week. Also, it's also on the podcast. So again, going public is a tool that you should use. But like anything else, you should be very cautious. You should get excellent advice, independent advice. Don't take the advice of somebody that's has a vested interest in the vehicle that you're going to be acquiring. You need third-party information on making that decision. You've been listening to Business Pulse Talk Radio. I'm your host, Michael Brette. And again, we have white papers on Regulation A+, the facts and figures and timeline that it would take to go public. We have information on reverse mergers, the cost and fees involved with something like that. We have information on the requirements for a NASDAQ listing. So if you did take your company public and you're an OTC, over-the-counter stock, and you want to get uplisted to NASDAQ, we've got the requirements that you're going to have to meet at a minimum to uplist your company. We also have information on how you can do an at-the-market financing so that you don't get snagged up in some of this convertible debt and toxic equity lines of credit. Now, having said that, not all convertible debt and equity lines are bad. You just have to look at the terms and conditions to make sure there's a floor price at what the company, the investor company, can convert their stock. If there's no floor, that means they could hammer the stock down to nothing. And they can still request stock from your company and still move that stock into the market. Well, we're about out of time here for this show, and I appreciate everybody tuning in. Next week, we have a very special guest coming into the studio. We're going to be live in studio. We have Pharma Green Biotech. It's a Canadian company that's in the hemp business with some very strong proprietary technology. Stock symbol is PHBI. PHB like boy, I. PHBI. They're an exciting company. I'm a consultant to the company. They're going to be in talking about their product, and we're also going to be doing a series of road shows for them here in the United States. And even though they're a Canadian company, they are listed here on the OTC market. And we are working with that company to get them uplisted sometime next year to NASDAQ. So next week we're going to have an exciting show talking about Pharma Green, their technology in the hemp, supplying starter plants to growers of hemp product that are disease-free. And that's a very critical element, and I'll let the CEO, who will be in the studio next week, I'll let him explain that. Again, you've been listening to Business Pulse Talk Radio. I'm your host, Michael Brette. I want to thank everybody for tuning in today. And again, don't forget to send me an email and request our white papers, or send me an email just if you have a question. Mike Brette, BRETTE, @gmail.com. I'm here to offer some assistance, but keep in mind, it's limited because we are a fee-based consulting firm. We do charge for our services, but we have certain phone consultations that are at no charge, just so we can get a feel for what you're looking for and what you're trying to accomplish, and we advise you accordingly. Again, I want to thank you for tuning in to Business Pulse Talk Radio. I've been your host, Michael Brette. And again, tune in next week, Tuesday, 10 a.m. Pacific time, on OC Talk Radio to listen to my new client, Pharma Green Biotech, stock symbol PHBI. Thank you for tuning in.
You've been listening to another example of Business Pulse Radio, right here on OC Talk Radio, Orange County's only community radio station.